Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. Okay, well, I'm excited for the next episode of the Investor Podcast. I'm here with Ashish Shah. He is a vice president at Syon Capital. Syon Capital is a multifamily office. They provide holistic planning and strategy, specifically when it comes to tactical asset allocation, weighting guidelines, thinking about how clients are managing their assets and, how they're looking at asset allocation. And instead of just simply assigning allocations to kind of main asset classes, coming up with more of a curated approach. So Ashish, thanks for coming on the show. And, Ashish has been really helpful just kind of on the platform and community side for Syon Capital. I got to meet him at one of our dinners, and he's been involved in our fund accelerator cohort, and just a great guy. So, excited to have him in my orbit, and honored to have him just talk about all the great things that he's building.
Thank you, Joel, for having me. Really appreciate the opportunity to speak to you and to your broader audience. I know there's a lot of folks that are part of the Syon Capital community, as I see on the Slack chat. So excited to talk and share, my knowledge and thoughts on the multifamily office space.
Yeah, absolutely. Well, Ashish, why don't we kick this off? Why don't you tell me a little more about just kind of your background, your career? Where did you go to college? What did you think you were going to do? Did you always think you were going to, be part of a multifamily office? Or, everyone has all these different, tops and turns in their career, and they pivot. I pivoted 3 times. So would love to learn your journey, starting from, maybe where you grew up and how you got to where you are now. And then I will probably, if it's okay, jump in or add commentary along the way.
Absolutely. Yeah. Like you, I also pivoted quite a bit in my career, like I think many people do. No, I never thought I'd be where I'm at today on the family office side. But I started off, I was born and raised in the Bay Area in San Jose, California. I did my undergraduate at Berkeley, which was a great experience. And there actually, I did a double major in environmental science and economics. And so actually coming out of school, I thought I was going to go into the environmental field. And I did for about a year. I worked for an environmental consulting firm. And I had 2 passions. I had the environment, and I had sort of econ, Wall Street, and the business side of me that were both fascinating. I tried the environmental consulting route for about a year, but realized it wasn't sort of the right fit. There was a lot of field work, and it was stuff that didn't really suit me. And so then I did pivot from there and then pursued my other sort of strong passion, which was finance. And so I worked at a boutique investment bank called Hambrecht & Quist, H&Q. They were considered one of the 4 henchmen back in the day during the early tech wave, if you will. They were one of the early pioneers in the tech world. Their claim to fame was taking Apple public. I worked there in equity research a couple of years covering the enterprise software space. And it was a great experience. I loved it. I learned a lot about the markets, Wall Street, and then just how to research and analyze companies. And after that, for a few years, it was around 1999, 2000. The dot-com boom was just, really almost hitting its peak. And I wanted to try my hand in that space, and specifically in the software space, covering the software sector. I was always looking on the outside in of how these companies operated, but never knew what it was like to be inside. So I thought it'd be a great time to really understand how companies work on the inside. And so I joined a couple of companies over a few years. One was a startup company. One was later Sun Micro, which was ultimately acquired. And I got to do some product management, product marketing roles. It was a great experience. Learned a lot, but it also told me that I'm not a product builder from that sense, and I'm not an operator. So I realized pretty clearly at that point that I wanted to go back into finance. I'm more of an investor. I really like looking at all the dynamics that take place in the economy, trying to understand where things are going, whether it's new emerging investment opportunities, new technologies, and just the macroeconomic environment, how everything's going to impact each other. I love that sort of thought process. So I came down to LA for business school. I attended USC, the Marshall School of Business. And out of school, I joined an investment management firm where I was in the fixed income space. Specifically, I was focused on high yield and leveraged loans, so it was aka junk bonds. And there, it was a great opportunity to really understand another set of investments which I had not exposure to, which was fixed income and the way it trades, the inefficient asset class that it was at the time. Really digging into the weeds of these companies across all different industries I had never had exposure to, things like the chemicals industry, industrials, a lot of the mainstays companies that tap this type of market when they need financing. And then also, you just doing the whole sort of qualitative and quantitative analysis of this. So it was a great experience. I did that for nearly 20 years. Starting off as as an intern, an analyst, and then ultimately worked up to a portfolio manager, where I got to run, at its peak, close to $500 million of assets there. So it gave me really great exposure to be on the buy side versus the sell side. And then after that, that kind of ran its course, and I was kind of getting tired, and I was looking to look at the investment world from a holistic standpoint, associated with one asset class. I want to look at all the asset classes from sort of a higher level, and so that's what got me into the wealth management family office space. I knew I had a lot to lend. I understood the markets at a much deeper level, but I wanted to be able to look at all the asset classes, the ones where I was not getting to touch upon, so private equity, venture, and whatnot. And so that kind of led me here. And then two, I like the client component of it. I really like enjoying talking to prospects and families and helping them think through sort of all their challenges and issues, as an element I was not getting sort of access to in my prior lives.
So I had some experience in product management. What do you think some of the superpowers of a product manager are that's kind of helped you become an investor? I mean, if any.
Yeah, no, I think there's a lot. In product management, there's a lot of time management skills, right? There's a lot of deadlines you've always had to hit, and inevitably there's always roadblocks that were thrown up in there. Whether it's delays from engineering or other parts of the business. So really understanding how to manage that, and that timeline is critical. So time management is essential in my investment world. Oftentimes, investment opportunities come up, and you don't necessarily have the full amount of time you would like to properly due diligence an investment. You have to make decisions quicker. So to be able to dissect that information that quickly was important. And then the people component, in product management, I was working with a lot of different groups of people, and to understand different personalities, different objectives each person has, and be able to manage that to keep everyone rowing in the same direction is critical. And again, I've had to apply that here when I'm working with both our internal team members, with our external clients, third-party partners in that. And so making sure that all those pieces are kind of working together and everything's moving forward in a relatively smooth and efficient manner.
Yeah, and I'm actually going to ping your website here so people can have it for reference. One thing that I thought was really cool was this graphic that you can hover on, and it looks like two of the main things that are interesting when it comes to a customized investment portfolio is obviously, a core long-term portfolio and then opportunistic tactical holdings. So would love to kind of unpack what you're, continuing to build at Syon Capital, and then maybe after covering the investment approach, maybe talking about kind of the holistic approach and suite of services that you guys offer to families, and maybe some of the profiles of the families, family, I was talking to you earlier, like a family office, a multifamily office that I was talking to yesterday was mainly focused on first gen. So a lot of those people don't have that infrastructure in place. They're just maybe coming into liquidity. They've maybe exercised their QSBS, but they don't have a formal investment office or like an outsourced, CIO. So kind of having someone come in and kind of, add that rigor and best practices to kind of think about the foundations is pretty helpful. But, maybe you can unpack that a little bit if possible. And then one more thing, I hear a little bit of static. So if it helps, maybe see if you can mute me when I'm talking, if it helps. If not, don't worry about it.
Sure. Yeah. Okay. So hopefully it's clear, at least on my end.
Yep.
Okay. So we'll start with your first question, so on the investment platform side. So at Syon Capital, we provide a full suite of services. And as we talk about the investment platform, it is a curated investment platform, but it is broad and diverse and is continuously expanding. So, to break it down, we'll break it down between public and privates. On the public side of investing, we have an internal team here, which I assist with as well as part of my role here in developing the asset allocation model. So we research, it consists of 35 plus ETFs across equities and fixed income. So it's diversified across geography, sectors, and kind of what's in valuation. Sort of main sort of metrics we'll use to develop that asset allocation model. There are multiple asset allocation models depending on clients' risk tolerance and their investment objective. This model is changed on a monthly basis, rebalanced. It's reassessed on a monthly basis. Maybe there's sectors that become out of favor or in favor that we will add weightings to. Same on the geography side, same on the weightings between equity and fixed income. And then on top of that, we overlay those strategies with tax loss harvesting components. We're big believers in generating tax losses when capable. So we use that quite a bit in our models for our clients. And then in addition, for clients that are looking for additional income and to help sort of minimize volatility, we'll use option overlay strategies, put right strategies there. And that's really on the public side. And then on the private side, it's again another curated side of investment platforms. We kind of look at everything. Being an independent firm, we have the ability to invest across any type of asset class. So it's private equity, private credit, real assets, venture, and then the fifth category, which we'll call, for lack of a better term, uncorrelated assets. So think of like sports franchises. We've been investing in some NBA teams as an example. The research, it's constantly being developed. So one of the strategies that we recently launched was a venture fund-to-fund strategy. This is something that it was in part because of the timing of the market. Venture had, and back in 2020 and 21, venture was a hot asset class and valuations became stretched in our views. And many of those folks who invested at that time in those vintages are still struggling a bit. There's been lack of liquidity, and they were buying or investing at peak valuations. That since has changed now. Valuations have come down and moderated some. And we think right now is a really great time to get into venture. Of course, a lot of tailwinds, right, with AI changing the landscape across all sectors. And we believe that the markets should hopefully begin to open up and to thaw so we can get some liquidity too. We think it's a great time to dig in that space. What we did with it, though, we're very cognizant about being diversified. So we're always looking for strong risk-adjusted returns. We don't try to necessarily go for grand slams when we're investing. We're trying to hit a lot of consistent doubles and singles. And so that's why we're really focused on strong risk-adjusted returns. So the venture fund-to-fund strategy was designed to have 7 to 10 venture capital managers diversified across stage. So we have a handful of early stage, handful of growth, and handful of late stage. And then it's diversified across the types of managers that we're using as well. So some managers will have, expertise in a handful of sectors like deep tech, SaaS, CPG. Others will be in health tech, fintech. So we're also and all of them have different approaches. So in theory, if we were to select the top, say, 10 managers, and we get lucky and we have literally the 10 best, on paper, we would be returning the same type of return as if you were invested with one of those managers, but you're actually getting a stronger risk-adjusted return because you're diversified across a number of managers. And then finally, because you're also spread across the timeline cycle, managers, again, theoretically should be cycling capital back to you faster. So you should be getting DPI quicker. So it's a good way to sort of balance getting returns on your timeline and then being diversified across a set of managers. So that's something that was unique that we've recently launched. We have 3 managers currently in there, 3 VC managers in there, and we'll be looking to add another set of managers in the third quarter of this year, and that'll kind of carry through towards the end of the year, early of next year. We'll kind of wrap up that strategy.
So some of the other products that you guys offer are what's the container that's in? Is that kind of an off-the-shelf product that you guys partner with other institutions on, or is it kind of a separately managed account that you guys have packaged together for some of the public assets? I think it sounds like the fund-to-fund strategy is just more of an LP position into the fund-to-fund, or I guess what's the best practice if you're building an MFO to offer these different types of products? What I've been hearing from some MFOs is kind of just almost like an account that you sign up for, but would love your thoughts on that in terms of like the best way to handle that.
Yeah, so we have a bespoke model. So clients can come in and choose their investments that they want to take part in. So they don't have to necessarily be a full-fledged client to come in and access our platform. So because of that, it's a lot of SMA strategies. We have developed both an SMA strategy that consists of private equity, private credit, and real asset funds. We partner with all third-party managers. We don't do any of this investment in-house. We select the third-party managers that we research and partner with. So companies like Apollo, KKR, Carlyle, Brookfield, Nova, are just some of the names we'll partner across all of these types of strategies. That could be purchased or invested in an SMA form. In addition, though, if someone wanted just to use one of those managers because they have exposure to other areas, they can also do that as well. But we basically are trying to choose not just which manager, but also which type of asset class we're doing. So we take it a step further. So, for instance, in private equity, the buyout market has been a little bit challenged for the last few years because of the lack of liquidity in the marketplace. The areas that have been attractive as a result of that to take advantage of that lack of liquidity have been secondaries and continuation funds. So we've been, when we're offering sort of our private equity investments to our clients, we're saying right now the time to be in secondary, being invested with secondary managers and managers who are involved in continuation funds because there's deep discounts and you're kind of past that J curve. And so there's some attractive qualities right now in that marketplace. And as things change, we'll then go back to adding more traditional, private equity buyouts as an example. So we're always constantly looking for within these broad asset classes, where are the niche opportunities in there?
Yeah, no, that's helpful. And then we'll love to kind of touch up on the suite of other, services that you guys offer holistically for wealth planning, and maybe you can talk a little more about kind of the maybe the profile of some of these families. You talked about sports teams. We talked about that obviously a couple times before, but where would people, what type of profile would, be interested in maybe buying some stakes in sports teams or maybe even acquiring a team?
Yeah, so to the first question in terms of our suite of services, so being multifamily office, we offer a broad range of services for all of our clients. That includes, as we talked about, our investment platform. But in addition, we have estate planning services. We have an in-house estate attorney on staff that clients are able to use as part of their, or as part of the being a client of ours. It's not something that's a one-off situation, or you have to subscribe to this. This is just part of our services. It's like a lot of tax strategies around that as well. We're very focused on taxes. We have a motto internally that we also tell our clients, which is we use the term net keep. It's not what you make, it's what you keep.
Sure.
So we're very focused on that tax component when we're looking at things, as well as the fee component. We're very fee sensitive in types of managers we use. We want to make sure that the fee that is being charged is justified, and or if we're able to negotiate better rates, all of which goes to our clients. And then we have administrative services. So for clients that need help with handling bill pay or some of their household items, we have services that take care of that. We have another area called family dynamics, oftentimes, or not oftentimes, but it does happen more often than you think, that families with a lot of wealth will have issues, whether it's between spouses, between children, between other relatives. And so we can help through a third party, help sort of navigate some of those challenges and how you share and distribute the wealth without getting into hopefully any sort of legal complications, to try to avoid those things. In addition, there's a lot of complexity around people and how they view money and how they handle money, right? Money can cause a lot of anxiety, guilt. It can also cause greed and pleasure, and there's all sorts of components. So it's all those kind of elements help talk about that. It's an area that is not often discussed as much, but it's incredible how much time I will spend talking to clients on that sort of therapy, if you will, financial therapy component, if you will. And then so that's kind of our broad range suite of services, and it continues to always build out. In terms of our client base and the types of clients, many of our clients are first generation clients. I would say probably 75% of our clients. Our firm is headquartered in San Francisco, though I'm in LA. And because of that, a lot of our clients come from the tech world. So many of them have been, were successful founders and had exits, or were executives at various tech firms. I would say about 70% of our clients come from the tech community, and the other 30% have made their wealth in all different ways. So the profile is they've come to us, and you alluded to earlier, many of them don't have a plan. They came into this wealth sort of overnight. What they know was how to build companies and how to build great companies. What they don't know as well is, okay, now I have this wealth, how do I manage it in a tax efficient manner? How do I manage it for legacy purposes? Where to invest, and why? And so we help them definitely with that. And then understanding single stock concentrated positions of clients. A lot of them come in with a heavy concentration, whether they're a private company or public company. So how do you navigate that single stock concentrated position and diversify so you're not so concentrated with that? So we help a lot of clients with those types of elements as well. We are now transitioning, though, because we've been around for a while and our clients have been with us for quite some time. These clients we're now in the talk, a lot of discussion is around that legacy planning. Many of them are getting to the point where now they want their kids involved. So we've actually started, we're in the process of starting what we call Syon Academy, which is really going to be built around educating our internal clients and their children or their heirs to their wealth, and how to manage this and what to think about, and how that's distributed. We have families that are more open with their children and tell them everything, and others that the children have no idea of their true wealth. And so we're helping to sort of educate them, and they're all different ages. So we are now in that legacy planning component.
Absolutely. Yeah, I think that's super smart. And what's really interesting is I've heard the concept of education a couple times. So, another one of my guests was Next Legacy. And I think they have like a Next Play Academy, essentially for like athletes and how they're thinking about their wealth, and even just teaching them what venture is. A lot of them may just not know about all the different types of asset classes. Maybe they only do public markets and they have a financial advisor that they work with. So I think when you provide a larger suite of services, there's a lot of education that helps people understand how to think about a multi-asset portfolio when thinking about their holdings in general. And I got a little bit of a loaded question for you that may not have an answer, but I'm just curious. So I know that you work with so many different families. What are some of the trends that you're seeing when it comes to their goals? Because usually when you think about financial planning, obviously there's the protection, right? The asset protection, thinking about how much you can keep by, leveraging some type of insurance products. But then there's also kind of the offensive approach where you're putting money to work, whether it's, into public markets, whether you're just going heavily into venture or real estate, right? So, based on maybe a couple different personas, like, could you walk me through a few of them? Maybe it's the tech entrepreneur, or maybe it's like the real estate mogul, but like, how do they think about their goals? And again, no worries if this is too loaded of a question. And I know once you meet one family office, you meet one family office, right? But if there's any kind of trends in terms of like how they think about portfolio construction or asset allocation might be helpful to be aware of.
Sure. So it's, yeah, I'll say a couple things around that. When our clients come to us, we generally invest everything at the fund level. So, I've come across a lot of single family offices that really prefer to take the direct approach, have direct investments into a handful of companies and be more involved that
Are
way.
those bigger families though? Because I would assume the bigger families, it's just too much overhead for them to do direct. So are they looking for like more like direct majority ownership in terms of like a larger deal? Is that kind of the situation, or is it just all over the
It,
place?
it is all over the place. The bigger
Yeah.
families definitely want the ownership and, board seats and maybe have a little more control.
Yeah.
Um, More often than not, it's like, club type deal. A couple of families will come in and they may not have full control or ownership, but they have a meaningful stake. But they want to be kind of involved in that sort of private equity type environment, but more at the ground level, as opposed to working with a fund manager. But what I have come across over time is that some of those families, depending on the larger ones, are a little more institutionalized and have a team in place and have the ability to support that team, because as you noted, it can be quite expensive on the cost side for a family. Families that are smaller, what I have noticed that they won't have the full-fledged team. They'll have maybe a couple of family members or maybe one or two people at most that they've kind of hired internally. And when you look at their portfolio, when they come to us, they typically are looking at single investment opportunities. So they find, okay, this opportunity is great, and they invest in it, and then they find the next one, the next one. But when they take a step back and you look at their whole investment portfolio, it seems to be a little bit unbalanced, and unbalanced in terms of what they're ultimately trying to achieve. So to your question, what you led off was like, what's the trend? What are they looking for? Most I've come across have this bias to be conservative to moderate risk tolerance. Yet some of their actions don't align with how they feel. So they come to us and we look at the portfolios. Okay, why do you have all these investments? You're heavily weighted here, your allocation. So we should, begin to scale this back as there's liquidity that comes in, and kind of develop a bigger sort of picture based on what your investment objective are. These clients have made all their wealth, whether through that a successful exit, or they just happen to be at Google for the last 30 years. Most of them are a little bit more in that asset protection and grow my assets at a moderate space. Again, hitting those kind of singles and doubles, if you will, in the baseball analogy terms. Those that do want to take on sort of that outside risk and really go for it, they will tend to take that capital and invest themselves. While we can always make an introduction to deals, we can introduce them to folks that have, that are going for those more aggressive type returns. We're happy to show that. But for us, they're really coming to us to help sort of protect and preserve that investment. So we tend to shy away from those types of opportunities, and let them go figure it out. And by the way, many of those guys have experienced doing it themselves, and they prefer to do it themselves because they've been in that space. So
I would say too, kind of like asset aggregation is a big, I'm assuming is a big piece too, because it's sometimes you don't actually have a visualization of what your assets look like, and you may not even know the percentage of allocations that you have across assets until you kind of professionally have some type of CIO handling that. So do you guys kind of serve in that capacity too, as almost like an outsourced CIO, helping them kind of organize that and visualize that better?
Absolutely. Yes. It's surprising to come across so many clients who don't know what they all hold and where they all hold it. So we will come in and we will, even if for assets that we are not actively managing, which we're not charging any fees on, but we have software systems in place to capture all of that. So we even have, for instance, we have one client who we manage a small percentage of this client's overall portfolio, but they initially came to us because they saw our tech stack, if you will, and that we were able to capture all of their investments, including all the K1s, capital calls, all the stuff on their private side, as well as all their public assets, in a unified view. And so now they can just go to one portal and look at everything they own and where it all sits, and have all the information, which then can easily be shared with their CPA when it comes to tax time, their estate attorney, and their other sort of key partners that they have. And so, yeah, they come to us for that, and we're able to actually properly manage. And then once we get that holistic view, when they see it, that's usually when they realize the value of providing, because we'll say like, here's what your portfolio looks like, and here's some, by the way, here's some ideas of what we think you should change. Again, based on your risk tolerance, your risk objectives, and they appreciate that. And some of them do, and that's sort of how you sort of build those relationships that we have found at the time.
Yeah, and I guess with your relationships in San Francisco, you're probably tight on the pulse of what's happening there. Obviously, I've been in New York for over a decade. I'm starting to go to San Francisco a lot more. But when it comes to manager selection, what are some of the learnings that you've had in maybe the last 3 months? Because you've already allocated to a couple managers. So, what are things that are important to you when you look at, obviously we talked about this in our session last week, but like, kind of like the hard skills of the managers, how they're communicating. And then as far as reporting, performance, what are some of the KPIs that you're looking for?
Yeah, I mean, it's a combination of things. There's no one specific component, but if we had to sort of break it down, it's the people, right? So anytime we're looking for managers, what's the reputation of the firm or its senior leadership? What have they done, led them to this point? What's their track record, and how did they achieve that track record? So that's very important to us, is that sort of people component. So we spend a lot of time talking to our partners to really get to understand them, their philosophy, and what they've done, because you can find managers that have great numbers but could be very challenging to work with or less forthcoming. So we really focus on that. We really focus on transparency. We do want our partners to be honest and upfront with the good and the bad. We understand. We don't punish anyone if they make mistakes. Everyone makes mistakes. Everyone has their misses on the investment side, and we get that. But so long as it's forthcoming and open, as opposed to trying to hide it and mask it and only show the wins. It's important to know the losses, because those are also valuable experiences too. When it comes to manager selection, we have a bias to look for managers that have been there, done that, so they have a track record. So we're looking at what's on the venture side. Excuse me, their what DPI they had, what MOICs have they had. If it's a private equity firm, what's IR, how did funds 1 through 4 do? What's the IR then, and what time frame? So we do look for that. That said, we've also partnered with an emerging manager, and we want to give those folks a chance. In those instances where we partnered with emerging managers, it's again that really then we're really relying on what did they do to get to this point? Where have they been? These are folks that they've excelled at the highest level at other sort of larger institutions, and now they're looking to break off on their own. And we love to support folks like that as well. So that's another component. And then, it's all the typical type, we're talking about the KPIs, all typical return metrics that we're looking at. And with that, if we're able to better ascertain how do they do it on a risk adjusted basis, right? It's one thing to get returns, but it's how the methodology you're going around doing it. And then the last thing, which I kind of brought up last time, it's interesting looking for managers in how they approach their investments, what's their philosophy. But what really strikes me, a lot of folks will try to use the marketing jargon, right? Obviously, everyone's AI, so everyone put that on there. But what does that really mean? How do they really assessing it? And more importantly, are they themselves utilizing it? I've only come across a handful of venture capitalists that are properly using AI as they diligence their deals. And yet these are the guys who are all, quote unquote, investing in AI. So I'd like to see, I come across manager, okay, here's someone that's actually using what they're investing in as an example of a differentiating factor.
Have you come across Yohei Nakajima at all? He's one of our graduates from our program. He's a great guy to follow on Twitter. He kind of builds all these AI micro apps, and kind of like right when ChatGPT released, his Twitter account went viral because he started just building all these really cool tools where like you upload a deck and then it kind of writes a memo for you. So he was one guy that that I thought was really interesting. He was in our cohort a couple quarters ago. But I totally agree. I think if you're if you're evangelizing AI and that's your thesis, it'd be really cool to kind of talk about actual tools that you use. And then if you can be a builder, I mean, Yohei actually builds these tools. So he's a developer himself. So I thought that's kind of crazy to be able to have the bandwidth to actually do that as well. So
Yeah, that's great. No, I don't know him, but I'll definitely check him out.
yeah, he's a good guy.
Yeah,
He,
it's
his stuff on Twitter is really cool. He'll post like a prototype that he built, and he showed, kind of some type of interaction that he had with like a wrapper on top of ChatGPT. So it's pretty cool, especially now with the whole agentic layer. I think that's really going to be interesting.
Yeah, and it's become a hell of a lot easier to build this stuff too. I mean,
Mhm.
I don't have any coding experience, but I was actually just looking at it actually last week because a friend of mine who is an engineer, it was like it's actually pretty easy to build these apps because you can just put it into Chat GPT and it really spits out the code and shows you basically how to make it. So it's become a lot easier to kind of build these AI tools and apps that you can use for yourself or in the workplace. So it's
Talking
pretty
about that,
exciting.
so I spoke to a family a couple months ago, and they reduced headcount by two people. So essentially, two of the analysts got replaced by a more senior. There's a senior person. What he did is he figured out how to use Claude and the premium versions of Claude and ChatGPT, and
Hmm.
they do some public markets investing as well. So they would upload a couple decks and spreadsheets into both of them. I'm not sure the actual permutation, but that the outputs from doing that reduced headcount by two people. So my question to you is like, where do you see this, really transforming wealth management? The natural thought for me is just all the data that you're ingesting and the accounts that you're aggregating. There's probably some prediction that or recommendations, but anything else, and maybe things that you're already using Chat GPT for. That'd be kind of interesting to just be aware of.
Yeah, I mean, we've started to use AI internally as well.
Mhm.
We've been using it right now on the front end. So when we get a prospect's, statements and their trust documents and all of their things associated with the family on their wealth and the wealth planning side, we're able to take all of this documentation and can summarize it within 10 minutes, which something that would have probably taken, a week, depending on the complexity of the client. It can really dumb it down in just in 10 minutes and really build out something really easy to slice and dice and use on the data front. So that's actually saved a lot of sort of time and manpower there. In addition, we've started using some tools, but we're further exploring and generating proposals. So in addition to analyzing all this data, is like actually how do you put this together in a nice clean format? So it's basically taking away all that time you spend on developing a PowerPoint slide and all those details. This is something that can actually really condense and improve that time. And then it just requires us to look it over and making sure it's hitting on all the salient points that we want it to. So we are using it there on that front. As we build out our workflow, we are looking at ways to further utilize it. So we're always looking. I like to say we're close to the forefront of early adopter in terms of technology at Syon. We do like to use quite a bit of technology where we can, where it makes sense, and if it can reduce time, increase services, and or manage headcount, we will.
What are some other just high level trends that you're hearing on the venture side? In term, you said that you guys are looking at deep tech. So I'm seeing a lot of these humanoid robot companies. Obviously Elon's raising for XAI. So there's going to be a lot of chat GPT permutations, and then many of them, like, I mean, from what I heard perplexity is really just a wrapper on top of chat GPT as well. So the AI piece, I feel like there's the API that can integrate into robotics, right? So that way you've got a relationship and kind of integrated workflows with robotic arms and stuff like that. But what are some other maybe some trends that you've been hearing about from the managers talking to, across any sector. I mean, I know we touched on deep tech and AI, but any other, I haven't heard much about climate in the last, probably 9-10 months.
Yeah.
So I'm not sure if it has anything to do with the current administration, but it's just, we had, even with our fund accelerator, we had a huge wave of climate funds and funds that were doing like the less sexy stuff, right? The infrastructure plays. And as you've seen, a lot of the managers that we're talking to are, back to software and B2B and healthcare as well. Like, so we're seeing a lot of digital health software, focused funds, but like, there's obviously a perspective of AI as well as they're kind of looking at those companies. But, we'd love to hear what you guys are seeing.
Yeah, I mean, I think it's the AI component is obviously, we talked about hitting all these sectors everyone knows. Where we're seeing sort of a lot of interest and energy. So climate tech, to your point, while it's not in the mainstream media, I actually am seeing a lot of it. It's just not getting picked up by the publications because it's, for whatever reason, taboo, maybe because of the current administration. But I am seeing, in fact, there's I just came across a company that's like, they are putting in sensors across all these utility poles across the state of California, and eventually it's going to go national, particularly in the electrical poles that are, in obscure or remote areas where it's harder to track, so you can detect basically early fire prevention detection. I think the other day I just read that Google launched a satellite component that can now analyze within a like 5 by 5 meter location of a potential fire that's occurring, like say in the forest. It used to be like acres and acres when the fire would be already at a hand. Now they're getting it down so you can locate it quicker. So I think there's still that push there, just not getting picked in the mainstream. I think VCs are not talking about as much, just because it's not necessarily in vogue at the time, even though it's a necessary item. Definitely health tech and fintech, I think, are areas that I hear quite a bit about. I think there's a lot of transformation that's going on in both those areas. As you know, healthcare could use always a lot more push to get through. It's very bureaucratic, just at, sort of at the administrative hospital level types of items. And then, of course, on the advancement of research, biotech. I mean, I think that's the most interesting area personally, is the biotech area. The amount of research and the speed of of discovering drugs and getting them to market faster. I think AI is going to accelerate that by 100x, if you will, in time. So I think that's fascinating there. And then fintech is an area that's also, hear a lot about. Crypto kind of, I don't know, it's kind of a mixed bag. Some people love it, some people hate it. But the technology, the blockchain technology, the underlying technology is actually permeating at a much faster rate, being adopted at a much faster rate across traditional finance. Right? A lot of banks and other institutions are using it, and incorporating it into their practice. And I think there's a lot of opportunity there. So I think fintech is also another area that we're seeing a lot of sort of interesting opportunities.
Yeah, I mean, I have an old friend from 20 years ago. We worked in the aerospace industry together, and we kept in touch. And he ended up working at Apple for some time, and then he left Apple and kind of started his own hardware company. And I didn't hear from him. Obviously, I got married and started a family and stuff, so we lost touch. But I just kind of like was wondering what he was up to recently, and I like looked him up, and he actually was at CES. And I think it's pretty interesting. So Marco, if you're listening, text me back, man. It's been 20 years. but he built this company called AeroCharge, and I think it's pretty interesting. So he created these receivers and transmitters where essentially, like, if you have a sensor on your phone, or like if you have like a sticker on your phone that's a sensor, and there's like a transmitter that's plugged into the wall, you could essentially wirelessly charge the room, using like radio frequency technology, like using kind of like essentially the waves in the air, right? So I thought that was just pretty groundbreaking. I'm just curious, like, why that, like Elon hasn't implemented some of that stuff, right? Imagine you just go into the room, and then because you're in the room, all your stuff is charged. Instead of trying to put your phone on a certain terminal, as long as you have that sensor and it's in range. So I just thought that's kind of the first thing that I thought was pretty interesting. So I like stalked him a little bit. I was like, oh, did he raise any money? Did he raise any money? There are other people. There was a company called Ubeam that ended up kind of being a scam. I don't know if you remember that. The woman, she built this technology where you could she sold it as almost like kind of being able to wirelessly charge. And then that company went, I think the company went under. So I think that was maybe, the last time I heard somebody do that. So Marco, if you're listening, this is your platform here. Maybe you'll get some customers. Give me a payment, a link to order your product. But I think that's kind of interesting. The whole energy transformation. That's every automobile manufacturer has an electric car now. So I think just kind of mobility is still a hot sector, and that probably falls under climate as well. So.
Yeah, it absolutely does. I mean, I remember speaking to a guy at Porsche Ventures, which is now actually putting a lot of money in. So even though it's Porsche Ventures and they're one of the anchor investors in the fund, it's actually opened to a lot of outside LPs as new to this individual. And of course, one of the areas they're focused on is mobility tech, but it's across everything, and it's not just for Porsche. It's just like, how do you sort of harness it? So I think there's a lot of great opportunity, whether it's the Waymo type self-driving vehicles, but a lot more on the infrastructure side is what I know. I'm talking to this manager, looking at the battery and how you enhance the battery, and then the software within these cars, whether it's on safety and those kind of elements. So interesting components there. And then we're seeing like Joby and these companies that are having potentially going to have drones driving us, dropping us off to and from the Ubers of the sky, if you will. And there's, that area is really burgeoning as well. So I think there's a lot of interesting stuff that's happening. They all sound amazing. I wish it would all kind of come to fruition, but obviously some can't. Cost, whatnot. Like to your point of this wireless, or charging, wirelessly. I think it's really cool.
Mm-hmm.
I think
some of the what I would say too with the deep tech side, there's a couple deals that we passed on a few years ago because like the life cycle to actually build a technology. There was a hypersonic plane, obviously, a different version than a competitor to I forgot the big one, Sonic. What's
Concorde?
the big hyper?
Concorde back in the day.
No, Boom. So Boom Aerospace, there was a competitor to Boom. So I was like, oh, I'm curious about this competitor, because we've done a handful of deep tech investments too. But like, the guy was like, hey, you know what? This is gonna take like 14 years to build. I'm like, that's almost like 2 fund vintages, I mean, so I feel like that is the problem with deep tech, unless you can just go out and raise a bunch of capital. So, one trend that I would say that I've seen is the deep tech, hard tech funds, that have been sub 20. There's one specifically that I know that had to shut down because they just self-realized that amount of capital is not going to be enough to possibly deliver DPI. So maybe that's the rise of the continuation vehicles to kind of double down and, reinvest in the strategy. But like, that's kind of my perspective on deep tech. Unless you can just go out and raise tons and tons of capital fast, it's just going to be difficult to still sustain yourself with like the manufacturing costs and the bill of materials that you have to fulfill.
Yeah, I think it's super tough. It's on paper, it sounds phenomenal to go after some of these big ideas, but in practice, which is why we'll see some of those failures. But I think what comes from those, like, okay, there's still IP that's been and research been learned and developed and created. So if you can just kind of break down in smaller pieces and then build upon that, right, find a little more efficiencies. I think usually what tends to happen, right? It's harder for a first time companies to come through and get it, nail it on the first try. Usually it's a failure, and then, but people will build off of that, or they rebuild off of that sort of technology. And so I think that'll happen, and that over time, the development cycle becomes shorter and shorter because of the learnings and new technology and faster ways of doing it. But so I think there's always that. It's always that iterative process. Exciting to see, but that's the hard part, and that's why we work with the VC manager to help us figure out who are those winners going to be. Because if I knew, I may not be sitting here today.
Yeah. Well, hey, we got 2 minutes left. Maybe we can leave the audience with just a piece of advice or a learning that you had, maybe for fund managers or just maybe professionals just trying to get to where they need to be. What's maybe a piece of advice or maybe a learning that you had in the last quarter or two?
I would say for the manager side, I would just say for the personal side, it's always great to be networking. I know this is kind of a random thing to say, but you never know where you're going to get help from and who's going to show up for you. So
Yeah.
I always take this motto. I do some mentorship with what's college students, and I always tell them, leave no leaf turned over, or turn over every leaf, I should say, because you never know where that help's going to come. So whatever you're trying to do in any endeavor, whether you're raising a fund, you're trying to get clients, whatever your objective is, you're always out there networking, meeting people, and people who on the surface may not seem like the one that's actually, you think, oh, that person has nothing to do with what I'm doing. I have found more often than not that that's the person that actually ends up helping the most, because while they may not be doing it, their friends are, or their colleagues are, and suddenly opens up a whole thing. So I have benefited dearly just from kind of being out there, meeting all sorts of people, and of course you want to be mindful of not chasing, throwing bad time after good time, and going down the wrong avenues. But by and large, I think if you do that, I think that helps no matter what you do. And just don't go after traditional avenues. So to the point of the VC, the VC emerging managers trying to raise, that it's first, $50 million fund, and they're going after all the family offices. Think a little bit more outside the box. You'll be surprised of other folks that will emerge, that will willing to invest in it, as opposed to just the traditional avenues only.
Yeah. Well, hey, Ashish, really appreciate it. Thank you for jumping on the horn. This was amazing, and this is a huge value add to the community. So thanks for all that you do, and appreciate the friendship. And let's hang out next time you come out here, or I come over there.
Love it. Yeah. Thank you so much, Joel. This has been fun. Thanks a lot, man.
All right. Thanks. Take care. Bye.
Bye-bye.